Hello students, I hope you're all doing well. Welcome to another video by QuickStudy, and this video covers depreciation from topic 2, Introduction to Bookkeeping. And in this video we are going to learn about the causes of depreciation and learn to distinguish between the straight line method of depreciation as well as the reducing balance method of depreciation. Besides that, we'll also learn how do you calculate and record depreciation in the books of accounts, and we'll also learn how to calculate and record the profit or loss when you dispose of a non-current asset. So firstly, let's take a look at what is depreciation. In the most simplest terms, depreciation is a loss or the fall in the value of an asset. Now, what causes this fall or loss in the value of an asset? So there are many reasons. So there are different types of non-current assets, right? There are machinery, motor vehicle, plant and equipment, and they tend to fall in value. One of the main reasons is wear and tear, which is basically physical depreciation. So non-current assets will eventually wear out because there is a natural element to it. So they'll maybe erode, they'll rust, rot, or decay. And there are economic factors of depreciation as well. So economic factors are why an asset might lose its value because it is outdated due to technological advancements over time, or there has been process changes. An example in the car industry, so assembly line, much of the assembly work actually is now done by robots, right? Which makes older assembly lines obsolete. And then there is the problem with inadequacy. Inadequacy arises when an asset is no longer suitable for its intended use due to growth or changes in the business or in the industry. So, for example, new regulations in the transport industry might allow you to use larger vehicles. So, what are you going to do with your older fleet of smaller vehicles? You're going to get rid of them, right? And this is how, due to inadequacy, you replace your older assets with newer ones. Alright, now that we have discussed the physical depreciation, which includes wear and tear, and then we have discussed the economic factors that contribute to depreciation, which includes the obsolescence of technology or inadequacy, you need to understand that assets will depreciate due to a time factor as well. So what does this really mean? So there are particular types of assets which have a legal life, and that is fixed in terms of years. Say, for example, a business may rent a particular property for 10 years, and a legal agreement is drawn up between the parties. And what happens is each year, a portion of the cost of the lease is depreciated until the lease eventually expires after 10 years and the value of the asset becomes nil. And in these cases, the term amortization is used as opposed to depreciation. And the time factor also includes depletion. So there are particular types of assets which are wasting, or assets that will eventually waste away. These are examples may include when you're extracting raw materials from mines or quarries, or oil from oil wells. So these are natural resources which will eventually wear out. And when they are sold in their raw state to other businesses for processing. So providing for the consumption of an asset of a wasting character is known as the provision for depletion. Alright, so now let us look at the methods of calculating depreciation. So primarily there are two main types using which you'll be able to calculate depreciation. The first that we're going to discuss about is the straight line method. So when we are calculating depreciation using straight line method, it involves the cost price of the asset, the estimated years of life that the asset will be in use for, as well as we need to have an estimated disposal value of the asset. So how do you really calculate depreciation using this method? It's calculated as cost price minus the disposal value divided by the estimated years of use. Now, for example, if a business purchases a car for £22,000 and it decides to keep it for at least 4 years, which is its estimated years of use, and then they might want to sell it for £2,000. Now, the depreciation charge will be calculated as the cost price, which is £22,000, minus the disposal value, which is £2,000, divided by 4 years, which is the estimated years of use. That would give you £5,000 of depreciation as an expense per year. And this is also known as the fixed installment method. So you may be asked in the exam to calculate depreciation or straight line depreciation using a fixed percentage. And this rate is actually derived from the number of years in use. And then the scrap value is considered, but it is just given as a percentage. So the question might say that Mike has purchased a motor vehicle for £25,000 and he wants to use the straight line method at 20%. So you would basically work out the 20% of 25,000 pounds, which would come out to 5,000 pounds. Alright, so the second method of depreciation that we're going to learn about is known as the reducing balance method. And calculating the amount of depreciation using this method involves using a fixed percentage on the cost price of the particular asset. So the percentage is deducted from the cost price in the first year and then in the subsequent years. And as you can see in this image, there's an example. So a machine is bought for 10,000 pounds and the depreciation will be at 20%. So the calculations for the first 3 years are calculated as follows. So here you have the cost price of the asset and the first year's depreciation. When you put 20% of 10,000 pounds, it comes out to 2,000 pounds. Now, here's the catch. So in the second year, when you're calculating depreciation, so the fixed rate of 20% is applied on the net book value of the asset, which comes out to be 8,000 pounds, and that is calculated after you have deducted 2,000 pounds, which is the first year's depreciation, from the cost price of the asset, which is 10,000 pounds. So this year, the depreciation charge will be 20% of 8,000, which comes out to 1,600. And now the new net book value of the asset will be 6,400 pounds. We've calculated this by deducting 1,600 pounds from 8,000 pounds. And for the third year, again, you'll calculate the depreciation at the fixed rate of 20% now on the new net book value, which is the 6,400 pounds. And in the third year, your depreciation charge will be 1,280 pounds. And then your net book value, which is also known as the carrying value, is calculated as 5,120 pounds. So using the reducing balance method means that much more or a significant value of the depreciation is charged in the earlier years of use than in the later years. And the repairs and upkeep in the early years will often cost less than when the asset becomes old. So this means that in the early years, a higher charge for depreciation and there is a lower charge for repairs and upkeep. And then in the later years, you'll have a lower charge for depreciation, but a higher charge for your repairs and upkeep. Alright, so now we are going to look at how you will record depreciation. So when it comes to recording depreciation, so a business will purchase assets or non-current assets. Now you'd have to record the purchase of that asset, and you would do that by recording the cost price of the asset in the respective non-current asset account. And any depreciation that is subsequently charged on the asset is separately recorded in a provision for depreciation account, and the depreciation charge will accumulate each year. So for example, if a business purchases a machinery for use in its workshop for 2,000 euros on 1st January 2014, the company will use the reducing balance method depreciation at 20% per annum, and their year end is on 31st December. So since you've purchased the machinery on 1st January 2014 and it's paid for by check, the journal entry would be you would debit the machinery account by 2,000 pounds and you'd credit the bank account by 2,000 euros. And we will not show the transaction for recording the entry in the bank account in this example. And so at the end of the year, the asset is depreciated at 20% per annum using the reducing balance method. So first of all, you would need to know what is the amount of depreciation that is to be charged each year. And this has to be calculated. So as you can see here, alright, so as you can see here, this is our calculation for the depreciation. So like I've already mentioned, the cost of machinery is 2,000 pounds, and you have the first year's depreciation using reducing balance method, which is 20% of 2,000 euros. It comes down to 400 euros. Now you have a reduced balance or the carrying value after year one, which is 1,600 pounds. Now for the second year, your depreciation again would be a fixed rate of 20% on 1,600 euros. Now your depreciation charge for the second year is 320 euros. So now your carrying value for the third year is 1,280 pounds. Now for the third year's depreciation charge will be a fixed rate of 20% on that 1,280 euros, which comes out to 256 euros. So your carrying value at the end of the third year would be 1,024 euros. So how do you calculate this carrying value separately? So you'll have the cost price of the asset at the beginning of the year, which was 2,000 pounds, and then your total depreciation, which has accumulated over 3 years, which is basically your 400 euros plus the 320 euros plus the 256 euros, which comes down to 976 euros. So at the end of year 3, your carrying value is 1,024 euros. Alright, so as you can see here, we are going to take a look at how you will record this depreciation or the value of the asset in the machinery account first. So this is your machinery account, right? So for your machinery account, on 2014 Jan 1st, if you can remember, we had purchased the asset for 2,000 euros. Then on 2014, we did not do anything else. So you have a balance carried down of 2,000 euros, which is later on carried forward or brought forward to 2015. Then you have a balance BD of 2,000 euros. Then at the end of 2015, you again have a balance CD since we did not have any other asset purchases as per our example. Then again, the balance CD from 2015 is brought down on 2016 again, right? Which is 2,000 euros. And then for the year, again, we have a balance CD of 2,000 euros, which is again brought down on 2017. As balance brought down, we have 2,000 euros worth of machinery, right? Now we're going to take a look at how we will record the depreciation for the 3 consecutive years in our provision for depreciation account. And that is recorded as here. As you can see, this is what our provision for depreciation account will look like. So here, first of all, you will see that we have the income statement. So when you record depreciation in the provision for depreciation account, we will record using income statement on the credit side of the provision for depreciation account for machinery. As you can see here, this is on 2014. At the year end, we have recorded it on the income statement, right? Because depreciation is an expense and this 400 euros is our expense for that particular year. So we record it in the income statement. And then for that year, we close the account or balance the account using balance CD. And again, on 2015, we have brought down the balance from 2014, which was 400 years. And then for this current year, which is 2015, our depreciation is calculated as 320 euros, as we have discussed in our example before, and we again record it as an expense in the income statement. Then for the current year on 2015, the balance is carried down. So now you have an accumulated depreciation balance on the machinery for 720 euros. Then again, in 2016, the previous balance is brought down, which is 720 euros. Then for the current year, in 2016, your depreciation charge is again recorded in the income statement as 256 euros. Now, your cumulative balance for the 3 consecutive years, 2014, 2015, and 2016, is totaled here as 976 euros, right? And then, just like that, you will bring down that balance again to 2017, the 1st of January, recorded as balance BD, which is 976 euros. And that is how you record depreciation in your provision for depreciation account. All right, now we are going to take a look at how you will record the amount for depreciation in the income statement extract and the statement of financial position extract. And this is what it would look like. As you can see here in the image, in the statement of financial position, the asset and the total depreciation are shown under the non-current asset section, whereas the asset, that is the machinery, is always shown at the cost price, which is 2,000 euros as per our example. And the total depreciation to date is basically 400 euros in the first year, 320 euros in the second year, and 256 euros in the third year. So the cumulative or total depreciation for the 3 years for our machinery comes out to be 976 euros. And this is shown as a deduction from the cost price of the machinery. So this will eventually give you a carrying value of 1,024 euros, which is calculated after you have deducted the total amount of depreciation, 976 euros, from 2,000 euros. So in the income statement, you will basically have the expenses for the 3 years, whereas in the statement of financial position, you will have 3 columns. You have a cost column, you have a total depreciation column, then you have a carrying value column. All right, now that we have looked at the different types of depreciation methods, we also need to understand how does the disposal of a non-current asset occurs. So why do you really need accounting entries for disposing of a non-current asset? So first of all, when an asset is sold, it must be deleted from your accounts. Otherwise, your accounts would be not reliable or inaccurate. This means that the asset's cost is removed from the asset account, and at the same time, the depreciation which the asset has incurred over the years also needs to be removed from your depreciation account. And finally, the profit or loss on the sale of your asset also has to be accounted for. So depreciation charges can only be actually estimated. And when a business will purchase an asset, they do not really precisely know when they will dispose of the asset or for how much can they actually sell it for. So when eventually they do dispose of the asset, the account that they receive is usually different from what they had originally estimated. And as you can see here in this screen, all right, so as you can see here, these are the different entries that you'll have to make in the respective accounts when you're disposing of a non-current asset. And this is, remember, this is an example for when you're disposing of an asset and you're making a profit. So how do you know actually, firstly, if you've made a profit on the asset that you've sold? So you have a carrying value at the end of an asset's useful life, right? So if the amount that you're selling the asset for is greater than the carrying value of the asset, you will have made a profit. Now let us see how does the recording of the disposal of a fixed asset on an asset account looks like. So this is your machinery account. So when you are selling an asset, you'll receive money, right? So you will you will debit the bank account for that particular entry. We are not showing this in this example, but you're also getting rid of an asset or a machinery, so you will record it on the credit side of the machinery account, which is your machinery disposals. And here we'll record the cost price of the asset, which is 2,000 euros. Now this is how we have removed the sold non-current asset from our asset account. Now we'll have to remove the accumulated depreciation of the asset from our provision for our depreciation account as well. And this is where they remove it, and this is how you're going to do it. So first of all, on 2017, as you can see, you had a balance brought down of 976 euros, which is basically your total accumulated depreciation on that particular non-current asset. And in order to remove it, you would have to post it on the opposite side of the account, which is basically the debit side of the account. So remember, when you're recording depreciation, it's on the credit side of the depreciation account, and when you are disposing of an asset, so you need to get rid of this depreciation, you post it on the opposite side or the debit side of the account. So as you can see, this is how you record 976 euros and get rid of the depreciation. Then comes the machinery disposal account. So here, first of all, you need to record the machinery that you're getting rid of in the first place, right? So this is your on the debit side of the disposal account, you record machinery for 2,000 pounds. Now where does this value come from, and why do you have A written here? So this is for reference purposes. I've taken this A from here, right? Now you know. So on the credit side of the machinery account, you had machinery disposals, and that value has come down to the debit side of the machinery disposals account as 2,000 euros. Then you need to know how much have you sold this machine for. So for example, we have decided that the cash, you've sold it for cash and you've got 1,070 euros for that particular machine. So this entry is actually coming from the cash book, and like I've already mentioned, that we are not showing the other side of the example here in this video to keep this short. Now you would also have to record the depreciation that you have incurred on the sold asset, right? Which is basically your provision for depreciation, as you can see with the letter here marked B, which is your total or accumulated depreciation on the disposals so far. And this B has come from here, which is the provision for depreciation account for the machinery. Now, how do you know if you've actually made a profit or a sale? So basically, you'd have to balance the accounts, and we have talked about balancing accounts before in our earlier videos. You'd basically total both the sides and see on which side you have a greater value. So by looking at this, I can already say that on the credit side, it will be greater in comparison to the debit side. So the balance will be on the debit side of the disposal account, which is marked as income statement. And the difference will come out to be 46 euros. What that means is that you have sold the machinery, and in the process you have made a profit of 46 euros. And where does this 46 euro go? The income that you have made on your sold asset. This will go to your income statement, and it is added as other incomes just under your gross profit As you can see here, you'll add it with the gross profit, which is the profit or on sale of machinery, which is the D. As you can see here, this is where the D has come from. And in the later videos, when we discuss income statement in further details, you'll be able to further clarify on this subject matter. All right, students. So similarly, when you sell a non-current asset, sometimes you make a profit, but that's not really the case. Sometimes you might make a loss as well. In that case, all the other entries in all the other accounts will be very same. Like the machinery account, you record machinery disposals. On the depreciation account, you have to get rid of the depreciation, which is very much same as what we have just discussed. The only difference will come down to the machinery disposals account. So here, after you've recorded on the debit side, which is the machinery's cost price, and then, like I mentioned, if you're making a loss, it means that you're selling the asset at a lower price than the carrying value that it has. So in our example, the machinery had a carrying value of 1,024 euros, but you're selling it for 950 euros, which is lower than the carrying value. So as you have recorded here cash at 950 euros and the total accumulated depreciation is 976 euros, like you already know. Now you will see that on the disposal account, the balance is no longer on the debit side, but rather on the credit side. So you will record the remaining balance as income statement on the credit side, and the remaining balance would be 74 euros. And what this represents is that you have made a loss. So it's only the machinery disposals account, after you've prepared the disposals account, you'll be able to know if you've actually made a profit or a loss on the sale of a non-current asset. And similarly, this 74 euros loss will go to your income statement, and this is put after the gross profit. And if you can remember, if you made a gain on disposal, you'll basically add it with the gross profit. But in this case, since you've made a loss on the sale of a non-current asset, you will deduct it from your gross profit. And this is a 74 euros, which we have got from the machinery disposals account. Alright students, with that we have come towards the very end of this video, and to give you a short recap of what we have covered in this video so far, we have talked about the different causes of depreciation. We have learned how to distinguish between the straight line method of depreciation as well as the reducing balance method of depreciation. We have also learned how you will calculate and record depreciation in the books of accounts. Furthermore, we have learned about how you will calculate and record the disposal of a non-current asset. And students, with that, I'd like to thank you for watching this video, and if you liked this video, do subscribe to our channel, since we post regularly on different topics and subjects that can help you ace your GCSEs. And of course, if you'd like to know more about us or our online tutoring services, do visit our website at www.quickstudy.uk. Thank you.